Hi everyone. Let's take a look at this demonstration where we'll explore payback, the accounting rate of return, and the net present value techniques to exploring capital budgeting. The problem is P25-1A. The elite company is planning to add a new product to its line. To make this product, they need to buy a new machine that will cost $300,000. It will have an expected 4-year life and a $20,000 salvage value. Now, its sales are all for cash and all costs are out of pocket except for depreciation on the new machine. Additional information also is included below. So we have the expected annual sales. We have some cost information. We know that the income tax rate is 30%. And we have 5 things that we need to do. Okay, let's do the first requirement, which is to compute the straight line depreciation for each year of the new machine's life. Okay, so we have straight line depreciation. And we know from the problem above that the cost of the new machine is $300,000 and the salvage value is $20,000. And the estimated useful life, the expected life, is 4 years, so divided by 4. And that takes care of part 1, computing the straight line depreciation. And I see we have a typo in there, so let me take care of that. And there's our answer to part 1. Now we need to determine in part 2 the expected net income and net cash flow for each year of the machine's life. Okay, I'm going to make a couple changes. Let's call this net income right here. Why don't we just underline that? And why don't I widen this a little bit? You know what, we'll move this over so that the numbers appear where we want it to appear. And we'll call this net cash flow. Okay, now what we can do is look at what we have and figure out whether we're going to get a cash flow from it. Well, we know that sales are made for cash, so that one will simply copy from there. The direct materials and labor, we can expect that those reflect cash out the door. Let me just copy this down. The overhead, same thing. We're going to pay for cash for that. The selling in general as well. Okay, now we've computed depreciation below, so we need to add that in. So why don't we insert a row here and type in the word depreciation. Say from below, right? And we'll add in that 70,000. Okay. And with that, we should be able to come up with what our income before taxes would be. Then our income taxes, our net income, and we could also work on our net cash flow. Alright, so the income before taxes is going to be equal the sales less the sum of all of these costs. Okay, hopefully you followed how I did that, right? We took the $1,150,000 and subtracted off the costs that were given in the problem, plus the depreciation that we had to compute. Income taxes are 30%, so why don't we just make income taxes 30% here, and take that times 30%. Turn that into a dollar value now. And come up with net income, which would be equal to 50,000 less the 15,000, right? And we really could double underline this. We do it that way. Take that underline off there. And so there we have the 35,000 of net income. Now, in terms of net cash flow, depreciation's a non-cash item, so we wouldn't include that in there. So if we then take this formula, we know that our income should be 70,000 higher on a before-tax basis. Income taxes, though, would still be the same because we're calculating income taxes based on the book income, not on a cash income basis. And then we can copy this over to come up with what our net cash flow would be. And why don't I just slide that down so it lines up with the title of net cash flow. Alternatively, we could also calculate it by saying grab the net income and then add back the depreciation. And so you see that that number gets you the same as that approach. Alright? So let me erase that for now, but I wanted to point that out. That takes care of determining the net income and the net cash flow for each year of the machine's life. And it would be the same because we're expecting the same kind of annual sales in each period. Okay, now let's take a look at part 3 next. Okay, now let's compute the machine's payback period, assuming that cash flow occurs evenly throughout the year. And I see I have another typo. So let me get rid of that. Okay, now what I'm going to do is slide so we get a little bit more room here. Alright, and I'm going to use my approach to how I would do payback. I'd drop in the word year here and just sort of list it going down, and drop in cash flows going down. Okay, and I would start at year 0. Alright, let me just enter it this way, right, so I don't feel like formatting it much. Okay, now we know that the machine cost $300,000. Let me enter it as $300,000, and we know that right there, previously we computed the cash flow as $105,000. And we know that we'll get 105 in every year. So let's look at our cumulative cash flows. And let me just insert one other row so we've got some room to work here. Alright, well, our cumulative cash flows, and I do want to enter this negative, is 300,000. Then from here we would take the 300,000 and add the current cash flow, and we can copy that down. Okay? So what it tells us is at the end of 1 year, since that's negative, we know that we have payback that exceeds 1 year. At the end of 2 years, we're still negative, so we know there's another year. Okay, now in the 3rd year, we see that we're positive by the end of the year, so we have to determine what was the fraction of the year that we remained negative until we turned positive. And how you would do that is you would take that 90,000, okay, and divide it by the full 105,000 of the third year that you have. And what that's telling us is the 90 divided by the 105 is that portion of the third year that it took before we went positive. Okay? Now I would enter this as a positive amount though, and now we know that it took 0.86 of the third year. So to calculate payback, I would simply sum from above, and what we get is a payback period of 2.86 years. Now, you could also solve it another way by simply taking the 300,000, right, and dividing it by 105,000 per year. And if you do that, you'll see that you'll wind up with the exact same result. Now, that works only when the cash flows occur evenly in every year. If the cash flows varied in various years, then we would have a different solution. Oh, and by the way, I've just noticed the fourth year cash flow is not $105,000. It's $105,000 plus the $20,000 that we're going to get for the salvage value of the equipment, because we're going to assume we're going to sell that. Okay? But right there is my approach to answering the payback period. Okay, now let's tackle part 4, which is compute the machine's accounting rate of return, assuming that income is earned evenly throughout the year. Okay, why don't we do this so we don't lose too much? Let's go back to the top. No, I'll slide about here, and what I will do is group this. And then we can slide it down. Okay, well, let's compute the accounting rate of return. Accounting rate of return is equal to the annual after-tax income divided by the average investment. Okay, well, in every year the income was $35,000, so we know that's the income portion, right? That would be the annual after-tax income. And now we need to compute the average investment. Okay, how would we compute the average investment? Well, we know the first year the cost of the asset was $300,000, right? And in the final year, the book value would only be $20,000. Because it would be depreciated down to the ending salvage value. Okay, I'll enter it this way, and I'll just sum those. Okay, now let's take the beginning, which is that first year, through the ending, divide it by 2 to come up with our average investment. Right, so if I do that, we know that the average investment is that 160. We certainly don't need pennies involved in this, right? In fact, why don't we format all 3 of these so it lines up a little nicer. And now we can compute what the accounting rate of return is. We'll do that right here. I can type it correctly by taking the annual after-tax income, and in this case that's also the average, right, per year, divided by the average investment. And what we get is a 21.9% average rate of return, or 21.88, but I think to 1 decimal is close enough. And that takes care of part 4. Or, excuse me, that takes care of the 4th requirement. Okay, now let's take care of the fifth requirement, which is compute the net present value for this machine using a discount rate of 7% and assuming that cash flows occur evenly throughout the year is what I believe that means to say. Throughout each year. Okay, now let's open this back up so we can look at where we worked on the payback. Right there is our cash flows that we generated before. And remember, we had a $300,000 initial cost of the equipment. Then we were going to generate the $105,000 cash flow, which we computed right there in our schedule of net cash flow. Okay, let me slide back down. And in the last year, we needed to add $20,000 to it, representing the residual value that we think we're going to get when we dispose of the equipment. Okay, so if we know those are the cash flows, then for part 5, we can compute net present value. This one is relatively easy. We use the NPV function. I'm going to hit the formula bar. Now that won't appear very nicely on your screen, so let me move it. We're going to need the rate, and in this problem we assume a 7% rate right above my mouse. I realize I'm moving that. So since I don't have any place to take it out of a cell, I can simply type it in. Okay? And then the values would be at the end of years 1 through 4, right? But to compute net present value, we still need to assume that we have to back out, or add in, if you will, add in a negative, the cash flow from the first year. Okay, let's widen this column a little bit. And we come up with a net present value of $70,915. We don't need pennies again. I'll put dollar signs and get rid of the pennies. And that takes care of right there the last requirement, which was to compute NPV at a 7% rate based on the cash flows